Hello YouTubers, welcome back to the Independent Investor. This week I'll start off about talking about some trades I did last week. With the coronavirus, I decided to actually be fairly aggressive and move to about a 40% cash position. It's not something I would normally do, but looking at some other spreadsheets and data that I keep, I noticed some other headwinds for the market that I feel maybe now is the time to take some profits off, especially on stocks that were predominantly I bought for the dividend, but have had fairly large capital gains. I'll go through those. I'll talk about the headwinds. I'll also talk about a few option plays that I did, why the market was going down. Of course, now the market has fully recovered, but I'm hoping they'll still be relatively safe. So starting off, I sold 3 utility high dividend paying companies. I had Capital Power, which was paying when I bought it 6 some odd % dividend, but you can see on this chart here how, just over the last year it went from 26 up to $36, and a company like this I might expect to go up $1 or $2, kind of at the top. And so to me, when you're buying a dividend stock, hoping to get a 5% return or 6% return a year, but the stock goes up 25% on a capital gain, and the underlying company hasn't really changed that much, then to me it makes some sense to take some money off the table and hopefully wait for that stock to come down to a more reasonable valuation. So I saw the coronavirus is kind of just a bit of opportunity to maybe lock in some of those profits. So that's one, I did that too. The other two are pretty much the same. Interact Power, I think I've talked about videos in the past. I really like it. It's mostly green power, wind and solar. It's one I hope to buy again at some point when it comes back down to a more reasonable valuation. Again, this, the last year went from 12 right up to 18. I mean, a good growth stock growing at maybe 20% a year, you can't get that kind of performance. So, and then the last one I've also owned again for quite a long time is TNET.Q renewable. Again, quite a bit of green power, but it's just gone almost parabolic. You think it was a cloud technology company or something like that. Last year we were down at $10. It's gone all the way up to $16. And you can even see here how it's just kind of been going straight up. Again, there's nothing really dynamics changed with these companies. They continue to grow, build out more solar and wind projects, but nothing to really justify that. Some of that is with interest rates, coming down, and treasury bills makes these companies, more attractive. But I just felt it was a good time. I didn't sell all. I sold roughly about 50% of what I had of these 3 positions. The only purchase I did do last week was TNET, which I mentioned in the previous video, small human resources company. I'll actually just move the chart over here so you can see. It actually filled this gap that I talked about in the previous week, and it looks from that it continued to trade up from the gap. It was affected by Friday, by the big down day in the market. and but then it has quickly recovered, and I thought it was an opportunity to buy a little bit more. As I said, I still think the company is a little bit on the overvalued side, so I did a covered call up here at $70 for $2.90. So that's in September. If the stock is above 70, I have those 100 shares taken away from me. But for that privilege, I get, I just did one contract, so that's $290. So I do continue to like that company there. Moving on to the actual headwinds I was talking about that I see in the market. There's a few. Let me just bring it up here. Basically, the coronavirus, I think we might be underplaying that a little bit. Basically, the rally in the last 2 days is again just talking about the Federal Reserve banks again injecting money into the economy, and everybody thinks everything's fine again. The China Central Bank has injected money into the economy, but I can't believe that the economy is going to turn around on a dime. We don't know how long this virus is going to last for. SARS about 10 years ago really affected the market for about 3 months, and it wasn't a huge drag overall, but Chinese has taken a lot more drastic steps this time to try to contain. I mean, we know there's, in Wuhan province, 16 million people basically locked up in their houses, schools are closed, businesses are basically shut down, and people have talked from the economy going from 6% growth down to about 4%, which I think is quite realistic, and typically the numbers are overstated coming out of China. There used to be an old saying, when the United States got a cough, Canada would get a cold. I think now when China gets a cough, the rest of the world can get a cold. So if we see a prolonged slowdown, if this virus goes on for longer than expected, and even with what's happened to date, I think the markets aren't correctly pricing that all in. Also, the markets responded positively when Donald Trump had a trade agreement with the Premier of China, but a lot of tariffs still are in place and haven't been removed. So we still don't know how all these tariffs are going to play out in the long term. So a lot of these effects we might not be seeing for another 3 to 4 months. So that's another reason I'm not quite as optimistic as the market. Another one that I can show on a chart is that the yield curve has inverted again. It did it last year, and I'll explain the seriousness of that. We can see the last financial crisis that I think that's the 10, that's the 5-year. The 5-year Treasury went over the 30-year Treasury, so it's inverted. All the inverted yield curve means is that the short-term rates are higher than the long-term rates. So right now, the other week we saw it with the bank, Federal Reserve Bank trying to increase interest rates. But with the virus outbreak and other indicators, the 5-year rate actually dropped below the 13-week rate. So now that is inverted. So the reason this is kind of has been a very good indicator of predicting recessions is that banks basically, you go to the bank and make a deposit, then they pay interest on the short term. In this case, we see the Fed 13-week there, it's 0.9%. So the bank might give you 1%, 1.5%, I don't know what the exact rates are now. But then they turn around and lend that money out to a business at 5 or 6%, depending on how risky the business is. On the long term, like I said, 5 years or so, or 10 years, and then the bank profits on the difference or the spread. So now the bank really can't make any money by lending out on the 5-year. So they'd be less prone to lend money out to businesses. Businesses then can't grow, slow down, and typically that can lead into a recession. So that's a very strong forecaster of a recession. There's also been a lot of volatility in the rates, up and down. It just seems a lot of uncertainty. And the federal bank's intervening, trying to control rates kind of all the time. And we can see on the 10-year, we've gone from 1.9% all the way down to like 1.5. And that's a huge percentage move. Plus, the 10-year bond historically has been an indicator of future growth in the economy. So if we're down at 1.5 or